Okay, let's dive right in. Today we are going straight into the engine room of the whole tech economy.
The semiconductor equipment sector.
Exactly. We're not just talking about the chips themselves, but the foundational machinery that makes them. You know, the picks and shovels of the entire AI revolution.
That's really the key insight, isn't it? These are the companies supplying the tools, the services, everything needed for fabrication. And in this environment, with all the volatility and demand, well, our mission is to cut through the noise.
Right. We have a huge data stack on three key players here: the giants, Applied Materials, and Lam Research, AMAT and LRCX.
And then the smaller, high-flying specialists, Photronics or PLAB.
Yeah. So the goal is to pull out the crucial signals, both financial and technical, to see where these stocks really stand today, December 10th, 2025.
And we should probably mention,
Well, for sure. This is all a journalistic analysis. We're breaking down the data we've compiled.
it's not, personalized investment advice for you.
Definitely not. We're just synthesizing the numbers. So where should we start?
Let's kick it off with the biggest one in our stack. Applied Materials. AMAT.
Okay, AMAT, the anchor of the whole sector. They make the super specialized equipment for global chip production.
Right. They're the leaders in processes like etch, deposition, and metrology.
Okay, for those of us who aren't engineers, can you quickly break those down? Why are those three so important?
Of course. Think of it like printing a tiny, tiny circuit. Deposition is like laying down the ink, these incredibly thin layers of material.
Okay.
Etch is the carving tool. It precisely removes material to create the circuit patterns.
Got it.
And metrology is just the inspection step, measuring everything to make sure it's perfect, right down to the atomic level. AMAT is a dominant force in all three.
And you can see that dominance in their scale. Market cap is, what, $219 billion?
219.2 billion with about 796 million shares out. It's a massive, essential part of the industry.
And the financials seem to reflect that. The margins really jumped out at me.
They're incredibly consistent. Gross margin is almost 49%.
And the operating margin is nearly 30%.
Right. And that profit margin, 24.67%. It means they're turning a quarter of every dollar of revenue into pure profit. That's just top-tier efficiency.
And the balance sheet, it's a fortress. The liquidity ratios, the quick ratio at 1.87 and current ratio at 2.61.
Which, for you listening, just means they have way more short-term assets than they have liabilities. They can handle a shock.
And their debt is so manageable. Debt to equity is only 0.32.
But the metric that really tells the story, for me, is the return on equity, the ROE.
Right.
It's at a really robust 35.51%. That's a huge signal of how well management allocates capital.
So we know they're efficient, they're making money. So the next question is, what's the market willing to pay for that?
Let's look at valuation. The trailing PE ratio is 31.71.
Which feels a little high.
It does on its own.
Yeah.
But analysts are betting on future growth to justify it. You have to look at the PEG ratio.
Which brings that future growth into the equation.
Exactly. And the PEG is high at 2.97. The market is pricing in a pretty big expansion. They're projecting EPS to grow by over 19% next year.
And the analyst sentiment backs that up completely. The consensus is a strong buy, a 1.80.
We've seen a bunch of upgrades. UBS moved to a buy recently.
But the big one was TD Cowen, right? On December 4th, they didn't just reiterate a buy.
No, they raised their price target from $260 all the way up to $315.
Wow.
And the sources say it's all about the AI boom, the uptrend in DRAM and high-end chips. AMAT is just perfectly positioned.
Okay, so with that valuation, let's look at the charts. What are traders doing? The stock closed at $275.15 today.
Up 3% in one day. It confirms this huge momentum story. It's up over 59% this year.
And over 1,300% in the last decade. It's just an incredible run.
But, and this is a big but, that run is flashing a technical warning sign for anyone thinking of jumping in right now.
The RSI?
The RSI, yeah.
Yeah.
The relative strength index is at 72.43. Anything over 70 is a signal that a stock is technically overbought.
It's gone too far too fast.
Pretty much. A pullback, or at least a period of consolidation is,
Yeah.
well, it's highly probable.
It's also bumping right up against its 52-week high, so it's at a decision point.
Either a strong breakout or, given that RSI, a potential reversal.
And we did see some minor insider selling in the data, which is just something to file away.
Good point. Let's make this tangible, a little paper money math. Say you put $5,000 into AMAT 3 months ago.
Okay, performance over that quarter was 61.71%.
So 3 months ago, the price was around $170.15. Your $5,000 would have bought you about 29.38 shares.
And today, those shares are worth $8,085.11.
Which is a paper profit of $3,085.11. A 61% return in 90 days. It just shows you the acceleration we're seeing.
Incredible. Okay, let's move on to the second powerhouse, Lam Research, LRCX.
A direct competitor to AMAT, also focused on that core processing equipment.
Slightly smaller, market cap of around $211 billion, but this is where the story gets really different.
It's all about operational efficiency. LRCX has an absolutely astounding return on equity.
Okay, so AMAT's was 35%. We called that stellar. What's Lam's?
It's 62.26%.
62?
Wait, what? Yeah, and their return on invested capital, their ROIC, is over 41%.
How is that even possible? What does that tell you?
It suggests their capital allocation, their processes, their service mix. Something is just fundamentally superior right now. They're getting almost twice the output from the same shareholder input as AMAT.
That's a massive competitive advantage.
It's huge. And you see it in the other margins, too. Profit margin is almost 30%, just edging out AMAT.
Their balance sheet is strong. Maybe not quite the fortress AMAT has, but still very healthy.
Right. And valuation-wise, the market sees this efficiency. The PE is higher at 37.08.
But the PEG ratio is actually more attractive.
It is. It's 2.01 compared to AMAT's 2.97. And the growth isn't just a projection. It's happening now. EPS grew over 44% last quarter.
And the whole narrative around LRCX is just extreme momentum.
For sure. Analysts are intensely bullish, 1.71. And the news is all about their investment in the silicon forest for AI leadership.
Then you get the psychological stuff, like Jim Cramer saying they're going to have orders as far as the eye can see.
Right. That kind of hype can be a really powerful short-term driver.
And technically, the stock is just. It's a beast. Closed at $168.26 today.
It's up almost 133% year-to-date.
And like AMAT, it's sitting right at its 52-week high. A clear breakout point.
But here's the key difference from AMAT. The technical structure is still strong, but the RSI is at 64.55.
So it's not in that extreme overbought territory yet.
Exactly. It's showing strong, controlled momentum. There's potentially more room to run in the near term before it flashes that same warning sign.
Interesting. We saw a similar note here in the data. The CFO of Lam was selling shares back in November.
Another data point to hold on to for the end.
Okay, let's do the math on Lam. $5,000 invested 6 months ago this time. The stock returned 85% in that period.
So 6 months ago, the price was around $90.95.
Yeah.
That $5,000 gets you 55.09 shares.
And today, those shares are worth $9,268.08.
Meaning a paper profit of $4,268.08.
Is an 85% return in 6 months. That is just wild.
It really is. It's what happens when you combine top-tier efficiency with a massive cyclical upturn.
Okay, so now we switch gears completely. Let's talk about Photronics, PLAB.
Totally different story. This is a small cap, a Russell 2000 company. Market cap is only $2.2 billion.
And they make photomasks, which are basically the stencils for printing circuits?
Exactly. And their financial profile is this fascinating contrast.
How so?
Well, their profitability metrics, like profit margin and ROE, are much lower than the giants. But their balance sheet is pristine. Absolutely spotless.
No, this is the metric that just jumps off the page. Their debt to equity is 0.
0.00, no debt.
And their long-term debt is also 0.
Which gives them phenomenal liquidity. I mean, a current ratio of almost 5. They are swimming in cash.
But that raises a question, right? Is having 0 debt actually the most efficient use of capital for them?
That's a great point. Maybe they're being too conservative and should be leveraging up to chase more growth.
Especially since their valuation, a PE of 21.15, is so much lower than the big guys. On the surface, it could look like a value play.
But you need the context. Their recent performance has been weak. EPS was down over 28% quarter over quarter. It's a very cyclical business.
And yet, the market reaction to their latest earnings was anything but weak.
It was explosive. Analyst sentiment is a perfect 1.00, the most bullish you can get.
And today, December 10th, the stock just validated that. The news called it their best day since 2008.
Look at the price action. The stock is at $37.35.
And the change today was plus 45.39%.
In a single day.
It gapped up by over 25% at the open and is now trading 18% above its old 52-week high.
A move like that creates some extreme technical signals.
I'm guessing the RSI is through the roof.
Oh yeah, it's at 88.27.
88. Wow.
That's not just overbought. That is severely, severely overbought. It's screaming that a sharp technical pullback is very likely very soon.
So for you listening, the takeaway is, yes, the earnings surprise was huge, but jumping in after a 45% single-day gain with an RSI near 90.
That is the definition of extreme risk. And, surprise, surprise, we also noted the CEO and directors at PLAB were selling shares earlier this year.
Let's run the final paper money scenario. $5,000 invested just 1 week ago.
The return for the week was 54.08%.
So a week ago, the price was about $24.24. Your $5,000 would have bought 206.27 shares.
And today, the paper value of those shares is $7,703.95.
A paper profit of over $2,700 in 7 days.
It's the perfect illustration of that high-risk, event-driven power you get with these smaller, more volatile companies.
Okay, so let's tie this all together. 3 snapshots of a thriving sector, but they tell very different stories.
They do. You have AMAT and LRCX, the behemoths. They're riding this massive AI and DRAM supercycle.
They represent that efficient, sustained compound growth. And LRCX with that 62% ROE, that's just exceptional.
Right. While AMAT is maybe the more stable, strategically positioned leader with those huge analyst price targets.
And then you have PLAB.
The small cap archetype. Super resilient because they have no debt, but their returns are completely event-driven. They can give you a year's worth of gains in a week.
So by comparing them, you really get a sense of the difference between institutional quality growth and high-risk, high-reward volatility.
Exactly.
But let's circle back to that one conflicting signal we kept seeing.
The insider selling.
Yeah. The sources confirm this sector is on fire, right? Unprecedented momentum, huge gains, new highs everywhere.
And yet we noted recent sales from insiders at all three. The CFO at Lam, executives at PLAB.
It just raises this really important final question for you to think about.
In a market where all the public signals, the analysts, the charts, are screaming by, why are the executives with the deepest possible insight into their own companies quietly reducing their personal holdings?
That conflict between public sentiment and private action, that's definitely something worth exploring further.